Welcome to Taxplained. In today's video, we're diving into a critical topic for multinational businesses: transfer pricing. This concept affects companies operating across borders and directly impacts how they report profits and pay taxes in different countries. By the end of this video, you'll understand what transfer pricing is, why it's important, and how it's regulated. Transfer pricing refers to the price at which goods, services, or intellectual property are transferred between related entities within the same multinational enterprise, MNE. For example, imagine a company based in the US that sells products to its subsidiary in Germany. The price at which the parent company transfers goods to its subsidiary is known as the transfer price. This pricing is crucial because it affects how profits, and therefore taxes, are reported in each country. If a company sets a transfer price too high or too low, it could shift profits to countries with lower tax rates, reducing the overall tax burden. Governments and tax authorities around the world monitor transfer pricing to prevent this practice and ensure fair taxation. One of the key principles behind transfer pricing regulation is the arm's length principle. This principle states that transactions between related parties, like parent companies and subsidiaries, should be priced the same way as they would be between two unrelated companies. In other words, the price should reflect what independent businesses would agree on in an open market. Let's take a look at how transfer prices are determined. There are 5 widely accepted methods for this, all based on the arm's length principle. The comparable uncontrolled price (CUP) method compares the price charged in a controlled transaction, like between two subsidiaries, with the price charged in an uncontrolled transaction between unrelated companies. If the prices are similar, the transfer price is likely arm's length. The resale price method, RPM, is used when a product is bought and then resold. The transfer price is determined by subtracting an appropriate gross margin from the resale price. For example, if a subsidiary resells a product to an external customer, the transfer price is the resale price minus a typical markup. The cost-plus method calculates the transfer price by adding an appropriate markup to the cost of producing the goods or services. This method is often used in manufacturing or service transactions between related companies. The transactional net margin method, TNM, examines the net profit margin of a controlled transaction compared to the profit margin in similar uncontrolled transactions. This method is useful when exact comparables are unavailable. Finally, the profit split method is used when both related parties contribute significantly to the overall profit. The combined profits from related party transactions are split based on how each party contributed. This method is often applied in situations involving intellectual property or other intangible assets. Accurate transfer pricing isn't just about setting the right price, it's also about documentation. Most tax authorities require companies to maintain detailed documentation that supports their transfer pricing methodology and proves that their transactions are in line with the arm's length principle. Without proper documentation, companies may face fines, penalties, or even disputes with tax authorities. To wrap up, transfer pricing is a complex but essential part of international tax compliance. By following the arm's length principle, using appropriate pricing methods, and maintaining thorough documentation, businesses can avoid costly penalties and ensure they're paying the correct amount of tax in each country. If you found this video helpful, be sure to like and subscribe for more insights on international tax and transfer pricing. Let us know in the comments if you have any questions or topics you'd like us to cover in future videos. Thanks for watching Taxplained.